Hey everyone, if you have been following the markets, you would know that there are a few names whose portfolios are worth watching closely. And one of them is Mukul Agarwal. He is considered a super investor with an incredible eye for spotting multibaggers early. As of latest quarter, his net worth from listed stock is estimated at more than 8,000 crore. And he publicly holds around 65 small and mid-cap stocks in his portfolio where ownership is 1% and above, that are spread across sectors like banking, pharma, real estate, chemical, and tech space. Some of his stocks like PTC Industry, Newland Lab, Intellect Design, Ethos, Hindustan Rectifier have delivered multi-bagger returns. So when Mukul Agarwal quietly adds a stock in his portfolio, the market takes notice. That's where in this video we'll break down his 7 recent Q1 FY26 stock picks. And of course, we'll try to answer the big question. Are these the next multi-bagger or just hype? But before that, let me clarify that the idea behind this video is to identify potential businesses. But you need to deep dive further before taking any investment decision. Also, there is no guarantee that if Mukul Agarwal has taken a position, he would continue to hold this stock. While he usually has a history of holding stock for a longer period, there have been a few cases where he exited within a few quarters. Another very important point to note is Mukul Agarwal has a very high risk appetite. Even if he loses a few hundred crores, it won't have any impact on his portfolio and lifestyle. So make sure that you invest based on your risk appetite. Also keep an eye on percentage allocation. Out of his net worth of 8,000 crore in the listed Indian market, some of his allocation might be very low as percentage of his total portfolio. Alright, let's get started. So first stock that Mukul Agarwal has added in his latest portfolio is Jammu and Kashmir Bank. Founded in 1938, Jammu and Kashmir Bank is a private bank but with a twist. Its largest shareholder is Jammu Kashmir government. As a result, it acts as RBI's designated agent for banking businesses in Jammu Kashmir and Ladakh, handling government transactions, tax collection, etc. So you can think of it as a quasi-government bank, listed as a private bank but majority owned and supported by Jammu Kashmir government. Mukul Agarwal has purchased 1.27% stake in the bank in June quarter. Now there are multiple reasons why he has invested in the bank. First potential reason is a decent credit growth in the banking sector. Be it consumption related demand or infrastructure, bank plays a crucial role in Indian economic growth. Plus, recently RBI has cut the interest rate as well as CRR. This should boost the credit growth for entire banking sector. Jammu and Kashmir Bank hold dominant position in Jammu and Kashmir and Ladakh region. Most government employees and businesses bank with them. That captive base provides steady deposit and loan demand. Although there are both private players as well as public sector bank in Jammu and Kashmir region, but J&K Bank still control the lion's share of deposits and advances in the Union territory. Plus, Indian government also has a lot of focus on reviving economy of Jammu and Kashmir. So, J&K Bank would play an important role. At the moment, bank has 878 branches within J&K and Ladakh and 141 branches outside the region, with focus on banking with 90% transaction as digital. Bank's asset quality has also improved a lot in last few years. Although bank's deposit and advances growth in last few quarters has been subdued, and the PAT growth in Q1 is around 16% year on year. But the key here is valuation. Jammu and Kashmir Bank today has a price to book of 0.8. So valuation comfort is high. During the last upcycle, its price to book peaked out at 1.4 and then valuation corrected. Its stock price jumped a lot post-COVID phase, but then it witnessed a solid correction. In last 1 year, stock has been in consolidation mode. Please note that J&K Bank has a relatively smaller market cap at the moment. And if bank can show good performance with the potential tailwind, there can be good upside. Of course, you need to keep a close eye on key risks like asset quality pressure, regulatory and political risk, and competition risk. Second stock that Mukul Agarwal has added is Yatharth Hospital. It runs a network of multi-specialty hospital in Noida, Greater Noida and Delhi NCR region with around 2,300 bed capacity, out of which around 1,600 beds are operational. And specialties range from cardiology, neurology to orthopedics, oncology and critical trauma care. Unlike premium players like Apollo or Fortis that cater to top segment, Yatharth target the mid-income population, providing advanced treatment at accessible prices. This gives it a large and growing addressable market. Company has been expanding both organically and via acquisition. It recently acquired a hospital in Madhya Pradesh to expand beyond NCR region. Company has been growing its top line and bottom line at very fast rate that also got reflected in the share price. However, there was negative news on some IT raid and that resulted in sharp fall in share price during the early phase of the year. but the stock has again recovered sharply from the lows. Mukul Agarwal has bought 1.14% stake in the company. Interestingly, DI's stake is also up in the company. The potential reason could be the strong tailwind in the hospital sector due to your rising healthcare awareness, increasing affordability, and insurance penetration boosting demand for quality hospital service. Yatharth is also expanding its capacity big time. New Delhi facility inaugurated in July 25 and Faridabad facility is set to operational in August 25, adding around 700 beds to the group. That would drive growth. Second driver is improvement in occupancy across hospital. Then third factor is enhancing super specialties to drive ARPOB, that is average revenue per occupied bed. And fourth factor is resolution of Ramraja Hospital land dispute. All these factors should result in strong growth for Yatharth in the coming quarters. Valuation wise, it is trading at one of the lowest multiple in the entire hospitality space. In fact, I have also discussed it in detail long back, and I am closely tracking this company quarterly performance in my exclusive weekly video series where I track more than 200 companies along with sharing my own investment strategies. The goal is to share knowledge on how to identify right companies and how to take decision on buy and sell. Again, it's not a series to give buy or sell tip. It's mainly for long-term investors who want to keep a close eye on the market to identify good opportunities, but they struggle with time. For more details, you can explore my website or join button of this YouTube channel. Then third stock is Onesource Specialty Pharma. It's a fast emerging player in India's CDMO story. Unlike traditional generic companies, Onesource focus on complex high margin area of pharma like injectable biologics, drug device combination like inhaler, pens, patches, and then soft gel formulation. Now I'm sure you would be aware that CDMO is a massive growth story in India. But if you look at Onesource financials, you would find that its profit before tax is actually negative. However, look at the top line growth, simply exponential. Even the traditional ratios like ROE, ROC are very low at the moment. CFO to EBITDA is negative. Still, Mukul Agarwal has purchased 1.14% stake in the company. Not only that, many top FIs and DIs are also showing confidence in the company. So clearly, we can't look at the traditional historical metric at the moment for the company to evaluate the performance. But then, what explains the bullishness of top FIs and DIs as well as ace investors like Mukul Agarwal? So first of all, Onesource is undergoing major expansion that include new facility, acquisition, and scaling biologics and drug device combination business. That needs lot of upfront investment. Also, there is an other income loss and very high depreciation. That has resulted in loss at profit before tax level. Otherwise, company's operating profit is high. Another big reason is this particular slide. Company's management has guided for more than 30% top line growth between FY25 to 28. And EBITDA is expected to grow 3 times during the same period. Margins are expected to jump from current levels of 32% to 40%. And targeted ROCE for the company is 50%. Company has already committed more than 50% of $100 million capex plan for the capacity expansion that is internally funded as well as with partner commitment and debt. In fact, phase 2 of capacity expansion would be operational a year ahead of schedule. Please note that Onesource has recently got listed in January 25 at around 1800 level and today it is at same level. Again, the traditional valuation metric are crazy high, but the key is company's future investment and its very high growth guidance. That said, some of the key risks that you should keep in mind are capex execution risk. Company is investing heavily both in capacity and in potential acquisition, which requires efficient execution. Any delay or cost overrun could erode margin. Also, maintaining healthy debt to leverage metric will be important. Then another risk is of course regulatory risk. Any adverse regulatory finding or delay in approval could hurt the exports or contract. Also, if the growth or margin disappoint, downside could be sharp as current valuations are already trying to price in a good amount of growth in the near future. Then fourth stock in the list is Tatva Chintan, a very interesting specialty chemical company in India. This is not your typical bulk chemical player. Tatva Chintan operates in niche high-tech segments like phase transfer catalyst, structure directing agents, electrolyte salts for batteries, and specialty intermediates used in pharma and agrochemical. Now, if you look at company share price, it has corrected massively since November 21 high. But recently, there's a good technical breakout in the stock, and Mukul Agarwal has bought 1.28% stake in the company in latest quarter. The reason is Tatva Chintan business actually sits at the intersection of multiple mega growth themes. First is clean energy and green chemistry. They make electrolyte salt that are critical for lithium-ion batteries that power EVs and renewable storage. As India pushes EV adoption and energy transition, demand for these salts will only grow. On top of that, Tatva Chintan is also focusing on green chemistry solutions that are more eco-friendly and in line with global ESG norms. Second driver is automotive emission norm. Europe and other developed markets are tightening emission standards. That means every vehicle sold there needs advanced catalysts to reduce emission. Tatva Chintan phase transfer catalyst and SDAs are exactly used in making those catalysts. Then third driver is agrochemical in India and global market are seeing massive demand for new age agrochemical intermediates. Farmers want high yield, climate change is pushing for better crop protection, and that means more specialty molecule. Tatva Chintan supplies some of these critical building blocks that goes into these agrochemicals. Fourth is China plus one opportunity in specialty chemical. Global companies want to reduce dependence on China for supply chain. That's where India's specialty chemical companies step in. With strong R&D base and export presence, Tatva Chintan is well placed to grab global market shares as customers diversify away from China. So essentially, whether it's EV batteries, cleaner cars, better crops, or the global supply chain shift, Tatva Chintan has a role to play in each of these themes. Plus, after last 3 years of correction, company share price to sale has fallen significantly. Again, you can't look at traditional valuation metric or ROE, ROC at the moment. Please note that management has guided for more than 25% growth in top line for FY26. But there are some key risks like cyclical demand in end user industry, raw material volatility, high R&D dependence, along with global competition and China factor. Then fifth stock that Mukul Agarwal has added is Valor Estate. Earlier known as DB Realty, it's a Mumbai-based real estate developer. Valor owns over 513-acre land across 25 plus prime sites in Mumbai and even in Lonavala. This isn't just land, it's a multi-generational value sitting in the heart of India's most expensive real estate market. The company has a history of unlocking land complexities that include clearing titles, securing approvals, and then partnering with tier 1 developers. This ensures projects get executed in a cost-effective and risk-mitigated way. Please note that Valor does not put massive upfront capital into each project. Its participation is usually less than 20%. Valor's main obligation is getting approvals done, while the heavy lifting of development is handled by partners. Financially, company has witnessed exponential growth, but its operating profits are negative. Its share price movement is also quite volatile. And key metrics for profitability and cash conversions are also in negative. Still, Mukul Agarwal has purchased 1.21% stake in the company. Even Rekha Jhunjhunwala is holding stake in the company. Although DI and FI are not showing much interest. So overall, the opportunity for Valor Estate is the ever-rising demand in Mumbai region, where company has 513 acre of land with asset-light business model. But the downside is earnings will remain lumpy and the business is heavily dependent on approvals and clearances. Then sixth stock in the list is Wendt India. It's a joint venture between Murugappa Group and Wendt Germany, and it specializes in your super abrasives, grinding wheels and precision tools that are used in industries like automotive, aerospace, cutting tools, ceramic, electronics and even defense. What makes Wendt unique is that it operates in a high margin niche segment with high entry barrier. Although recently its German promoter has exited. Financial wise, its revenue growth has been slow and net profit growth is also weak in last few years. Its stock price has also seen high correction in last 1 year. One of the reasons I can think why Mukul Agarwal might be interested in this company is the tailwind for the company due to exposure to sunrise sectors like your EVs, aerospace and defense, all of which are seeing strong policy and demand tailwind in India. Company has an expertise in niche precision tools that has a good entry barrier. And of course, they have the pedigree of prestigious Murugappa Group. Then last stock is Monolithisch India. It's a micro-cap company at the moment, but it's a fast-rising company in refractory or industrial input space that specializes in ramming mass, which is a type of lining on heat-insulating material used inside induction furnaces in steel, foundry and metallurgical industries. This growth is clearly visible in company's revenue and net profit. Company has been planning to increase its capacity from current levels of 1.32 lakh ton per annum to 1.56 lakh now, with roadmap up to 2.5 lakh ton per annum and longer term target of 5.74 lakh ton per annum. Please note that Monolithisch India's fortunes are tightly linked to the steel and metal sector cycle. Every time steel demand rises, more furnaces run at higher capacity, and every furnace lining needs regular replacement. That means higher steel production means higher ramming mass demand. So with India investing heavily in infrastructure, railway, defense and housing, steel demand is projected to keep rising. On top of that, experts are saying that there's a good upcycle in the metal industry for next few years. Mukul Agarwal has purchased 2.3% stake in the company in June quarter. But the flip side is also true. In a down cycle, when steel plants cut production, demand for ramming mass falls sharply. So Monolithisch is effectively a proxy play on India's metal or steel upcycle. Highly volatile, where it can grow significantly during upcycle, but right exit is also important before the down cycle. If you can understand the metal cycle, then only consider this stock. Please note that company recently got listed in June month for 143 rupee, but the stock is already up around 3 times, resulting in very high valuation. So there you have it. Mukul Agarwal's 7 recent Q1 FY26 stock picks from banks like J&K Bank to specialty chemical like Tatva Chintan, high growth CDMOs like Onesource, and healthcare company like Yatharth Hospital. His portfolio spans sectors with structural growth tailwind. But remember, these are high risk, high reward ideas. While Mukul Agarwal has a track record of spotting multibaggers, every investment comes with its own risk, cyclicity, execution challenges, regulatory hurdles. If you're thinking of exploring these stocks, make sure that you do your own due diligence, considering your risk appetite, and keep an eye on allocation size. Just because he holds does not mean that they are right for every investor. At the end of the day, these picks gives a glimpse into the kind of opportunity top investors are watching, and they might inspire your own research into potential multibagger. Now tell me in the comment, which stocks do you like from these 7 recent investment ideas of Mukul Agarwal? Thank you for watching this video. I'll see you next one. Till then, take care.